should I add more money to my policy? In today's video, we are going to look at an individual who's had a whole life insurance policy for several years. He actually started his policy back in 2016. He started at the age of 34, which is actually how old I am today. So when we first started his policy, I was 26 or 27 years old. I may have started talking with him when I was 26, but we have been able to see the actual performance of the policy over the years. And what I'll add about his situation is he has always had an entrepreneurial mindset. He's worked with startups, he's had exits, and my point to mentioning that is he's done well, but with respect to the policy, the funding has varied quite a bit. He's had years where he's pumped a ton of money into the policy, and then he's had years, like last year, he's about to end policy year 7, and he hasn't paid anything, not even the minimum premium. He does not have a loan outstanding right now. What he did in year 7 is he had the premium paid by the dividends and interest. This is referred to as a premium offset. So the earnings in the policy covered his premium for him, and then everything else came back into cash value, and it's performing quite nicely. The thing is, when we look at his situation as of today, I spoke with him a couple weeks ago. He said, Steve, I'm in a situation right now where I'm happy with the policy. I'm good if I don't have to make another payment into it ever. It's done everything that I've asked for. I've been able to use it for loans. I don't want to make any more payments though. The cash value I have in the policy, I'm happy with that. I've got other assets as well that I leverage for other opportunities. Like, I'm good where I am right now. However, I would like to see a scenario. I just had an event at my company and I've got a lot of money in cash. Trying to figure out what I want to do with those funds in cash. I do want to be able to use them for some real estate deals that I'm looking at, but I don't have anything on the horizon right now. So I can leave it in cash, but what would it look like if I throw it in the policy instead? What I'll add is he does not want to start a new policy. And this is something that's very important to mention, because if you're ever in a situation like this where you've stopped paying, or maybe you're just paying the minimum premium, but you've got room to add more money to the existing policy, if you take a whole life insurance policy, what's the worst part about any policy, with a new policy in particular? The first year, because money can go where? Toward the premium or toward the PUA rider. And if we just focus on the premium, we know how the PUA rider works. It maximizes the cash value immediately. But premium dollars, what shows up in cash value in the first year? Typically 0 with a traditional policy, which is the type of product he has. Beginning the second year, those premium dollars do generate cash value. So if he's got a policy that's 7 years old, it's about to enter policy year 8 begins March of 2023, what's happening? Premium comes back to cash value. PUAs come back to cash value. Policy's compounding, it's moving now, right? It's the good part. The last thing he wants to do is start a new policy and go through those early years again. A new policy makes sense if you don't have any more room to add funds to an existing policy. In his particular case, he does have room. So the question was, Steve, how much more money can I add? What's the payment I can make right now without triggering a MEC? A MEC is a modified endowment contract. We've got a million videos that talk about that. So the total MEC space he has on his policy is just about $375,000. Now the $375,000, this is not his annual MEC limit. Remember that unused MEC space rolls over from year to year. So the policy was set up with a MEC limit much, much less than $375,000. However, as the years have passed, any MEC space that he has not added to the policy, meaning I could have added up to $100,000 per year. 1 year, I only paid in $50,000, meaning I could have paid in an additional $50,000, but I did not. So what happens is that unused $50,000 rolls over to the next year, and now I can pay in $100K again, if that was my maximum, plus the unused $50 from the prior year. and it's cumulative. So unused MEC space continues to roll over, and in short, he can make a maximum payment right now without triggering a MEC of $375,000. And what I'll add is this is for the 7th policy year. He has not paid his premium in policy year 7. The premium was paid through dividends and interest. So what this means is if he elects to do this, it'll be a pure PUA payment. Now, the policy must be designed properly in order to be able to accept this payment. Typically what you need, at least with the top companies we work with, is a 1-year term rider, because this will prevent the death benefit from shooting up, which would result in underwriting being required. If your death benefit does not increase, which a 1-year term allows for, that creates a situation where I can slug a huge amount of money into the policy, really maximize the cash value, and not have to go through medical underwriting. I want to demonstrate that as well when we look at the illustration. So for the scenarios, here's what we're going to look at. A, what's it look like if I do exactly as planned? Don't add any more money, because that's what his plan has been really since last year. B, what's it look like if I add the maximum PUA payment without triggering a MEC, which is another $375,000. And then C, what's it look like if I add the maximum PUA payment and then continue to pay the minimum premium, which is a little over $13,000 per year. Let's take a look. So what we'll start off with is stopping payments altogether, because this is what he was originally interested in and is still interested in. So we're in policy year 7 right now, and this ends in less than a month. So here's what the cash value will be at the end of policy year 7, just about $225,000. This illustration is based off the company's current dividend interest rate, 5.75%. However, remember the dividend rate is not what you're actually earning. Here's the net internal rate of return, the annual IRR. So we're just about 4.3% year over year, which is pretty sweet. And then we've got the same thing in dollars. And a big point of interest here is this piece, that if we do things right, we can access that cash value tax-free. When I say do things right, I mean if we don't trigger a modified endowment contract, if we don't cash the policy out, even if the policy is not a MEC, if we cash it out, we've got to pay ordinary income tax on the gains. If the policy lapses, which it can lapse if I take a maximum loan and I don't pay anything back, I don't pay any loan interest, nothing like that. If it lapses, then it'll function similar to a cash out where the gains would be taxable. My point is, it's very easy to access the cash value tax-free, but I add all of those what-if scenarios to make sure that it's very, very clear that cash value life insurance can be taxed if we don't have awareness of what can trigger a taxable event. But anyway, that's additional information. The tax-free piece is what makes this very attractive to him. There's the cash accumulation over time. In year 8, we did chop the term rider. We eliminated the premium as well. You'll see that in the illustration in a second, in a couple minutes. And the cash value and death benefit appreciates over time. That's no payments. What does it look like if he makes a big old PUA payment? $375,000. What happens here? It looks pretty good, huh? So he makes that $375,000 payment, and this is just a pure PUA payment, meaning the premium is not included in that $375,000. Usually when we format Excel workbooks in this manner, it's including the premium and the PUA payment. In this example, this is just the PUA payment because the premium's already been covered. There's the cash value. There's the death benefit. Did the death benefit increase at all? No, it did not. The whole life death benefit did, but the net death benefit did not. I'm going to show you exactly what that means in a little bit. But what happens here? IRR is about the same. It's slightly stronger, but not much of a difference really when we look at it over time. Cash value growth is a higher dollar amount because the rate's the same or very similar. We've got a larger bucket of money. So I've got the same rate but more money. It's going to grow by more money naturally. I'm going to see a larger dollar amount, which is sweet. So that's a one-time payment there. And then the last what if scenario is, hey, what does it look like if I make that large addition and then continue to pay the base premium of $13,640? So we can continue to add funds to the policy. Now I'll say he's very analytical. He saw this. The first thing that jumped out at him was this. And he said, why is the IRR, the internal rate of return, lower in the example where I keep making the premium payment compared to the examples where I stopped? Like, why is that? I'm giving the company more money, so why do I have a lower internal rate of return? Doesn't make sense. The answer to the question is anytime we make premium payments, there's premium expenses. It's often referred to as a premium load. You can just call it a drag because there's a cost to making that premium payment. It's going to drag down the IRR a little bit. Now it's still attractive, but compared to the examples where I stopped altogether, I do notice a difference there. And often what I like to explain here, because some people who are interested in maximizing the IRR don't like this. And they say, okay, I don't want to keep adding more money anyway, so I'll stop early and maximize the performance. Some, on the other hand, will look at it and say, okay, I understand that the internal rate of return is a little bit lower, but I've got more cash value. I'm getting a slightly lower growth rate, but on a larger bucket of money because I continue to feed the beast here, meaning I'm adding more premium dollars, which are all contributing to my cash value growth and long-term death benefit when I look at it, which is nice. But again, it is a personal choice in this particular case. He's interested, probably in this option, but possibly adding this large PUA payment. So let's take a look here at these two. I want to explain this because this was a question or a topic of discussion that popped up. Why is the death benefit not increasing there initially? You'll notice year 8, there's a big difference there. So when you have a life insurance policy, money can go where? Premium or PUA payments. Everyone we work with is interested in maximizing the PUA rider because that is what is going to maximize the cash value. So what do PUA payments do? Well, we all think cash value. Yes, they grow your cash value. Let's do this. Cash value. But also, it buys you paid up additional life insurance. So a PUA payment will buy you more death benefit. How it functions specifically is when you make a PUA payment to your policy, it functions as a single premium whole life insurance policy. So it's just added to your existing policy. The company actually gives that PUA payment its own dividend as well. Now, when you receive your annual statement with the dividends and you see, here's the dividend I received, that's your total dividend from your base premium, PUA payments, and everything lumped together. But my point is, it receives a different dividend. But the big thing here, it increases your whole life death benefit. Let's emphasize that word, whole life. Because when we look at this policy, we see a death benefit of almost $3 million. How much of it is whole life and how much of it is term life? Let us take a look. So let's start with the example with no added money. So what we've got here, you see when he started the policy back in 2016, issue age of 34, preferred plus, that's the top health rating. Here's what we want to look at. Year 7 has already passed, or I should say the beginning has passed. So there's the premium in the beginning of the year. However, net after tax outlay, 0 in this particular case. Net death benefit, 2,968. There's the cash value at the end of this year. So this will be on his anniversary date in March. But look at this. Here's the term rider. 1.381. It's almost $1.4 million in term insurance. And if you like putting a puzzle together, you'll enjoy this a bit. So let's do this actually. Okay. So what I want to hit on here is this. where's your base face amount on this illustration? You'll see it up here, $1 million. Target additional benefit. What this is your term insurance rider. Add those two figures together, what do you get? There's your net death benefit of 2,968 and change. So day 0, before he added anything to his life insurance policy, the term rider was for this amount, and his whole life death benefit was a clean $1 million. Okay, got that. Going back to the PUA topic, when you add money into your PUA rider, yes, we think cash value, but what does it also do? It does buy you more whole life death benefit, which would increase this figure. So as the whole life has increased, the term has gone down. Remember, day 0 was almost at $2 million. Day 0 through year 7, now at about 1.4 million. So it's decreased quite a bit. How much exactly? Well, we can crunch in the calculator. Why don't we do that first? But here's what you'll like here. So let's take this 1,968, 677 minus face amount of 1 year term, 1,381,158 equals 587,519. And what does that match? Look at that. So this column, total face amount of adds, represents the added whole life death benefit that has been purchased from PUA payments and also dividends that have been reinvested into PUAs. So this column represents the added whole life death benefit. We would actually add this to this, the base face amount, and the term would be the difference, always keeping us at that initial death benefit of almost 3 million in this example. Very easy to follow, right? This is if you like putting a puzzle together and the mechanics. Here's my point. So this is the example with no additional funding. Let's look at the example where we've got the extra 375 going in. Because if you do that, yes, makes us happy regarding the cash value, but what's going to happen with the death benefit? Well, this column should be a lot higher, because if I add $375,000 to my policy, that should get me a whole lot of whole life insurance death benefit. So on the flip side, should also shrink that term rider quite a bit. Let's take a look. Here you go. What do we see here? There's the $375,000 PUA payment. What happened to this column? Check that out. Increased quite a bit, didn't it? How about your term rider? Look at this. 2706, all but gone in this particular case. Big bump to the cash value. Death benefit has stayed the same. But now, once we stop funding, we actually exercised a reduced paid up in year 8, which dropped the death benefit a bit. But when we stopped it, because we've added all of those additional funds, now we've got a larger death benefit too. Exact same policy. It's an in-force illustration, so we won't see any difference. Here's the last thing I want to mention that he did bring up. He said, hey, of that 375, like I'm looking at it, and I don't get the full amount back right away because it's a large PUA payment. And when I do make PUA payments, there are fees assessed to it. So if we do this, let's just look at this year. Equals this minus this is what? 357. But he paid in 375. So what I would do actually is subtract my payment. So initially, I do take a hit of about $17,000. The thing to be aware of, though, in this case, is when we ran this illustration, it was in February, which we're still in right now. His policy anniversary date is in March. So when we prepare the illustration, what happens is if he throws in 375, it shows what he will have at the end of policy year 7. It was less than a month from running this illustration. And then at the end of policy year 8, assuming the dividend does not change at all, well, the cash value will appreciate to 607, and the growth was 25. So he recaptures it pretty quickly, and he sees it continue to appreciate over time, which is nice. But a fun technical aspect as far as the net death benefit, term riders, and everything, he was analytical, so that was something we spent a little bit of time just walking through. In any event, I hope you enjoyed this one. Main purpose, or main item to discuss in this video and demonstrate is that if you have a policy and you have the ability to add more money to the existing policy, that will likely work out in your best interest. If your goal is maximizing cash value, that'll likely work out in your best interest before starting a new policy. Now, a new policy can sometimes make sense if you need more death benefit, you need or want more mech space, maybe you want a different company and more flexibility. There's a lot that goes into it. However, if you're looking at one policy, maximizing the cash value is your goal, and you're comparing that to potentially starting a new policy, usually you're going to see adding more to that existing policy will put you in a good position in most cases, not all, but in most cases. So I do hope that you enjoyed this video. If you did, please hit the like button, subscribe for more. Let us know if you have any questions below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.